In discussing funding options for your business, we're going to start by talking about traditional funding sources, which are loans from commercial banks. My name is Jane Rich, and I am a business advisor with the Northeast Indiana Small Business Development Center. In this session, the goals are to have you understand the types of financing that are offered by banks, learn how to match what you need with different types of debt that are available, and discover what you should expect from a lender. Banks offer both short-term and long-term credit to businesses. Short-term credit is typically found in the form of lines of credit. Lines of credit allow businesses to borrow to support short-term working capital needs. They enable businesses to offset timing differences from when inventory is purchased and then sold to clients and then receivables collected. So it really is a gap financing for a short-term period within a business to allow the working capital cycle to complete. Amounts that businesses borrow should be able to be repaid through the normal course of a business working capital cycle. The revolving feature within a line of credit is much like a credit card. You can borrow, repay, and reborrow up to a defined limit. Say there's a $100,000 line of credit available. You can borrow any or all of it, repay it, and reborrow it up to that $100,000. And lines of credit are typically reviewed by banks annually once they receive the year-end financial statement for the business. The business is required to pay interest on a monthly basis at a minimum if there are outstandings under a line of credit. Short-term notes are another form of short-term credit within banks. These are for a specific short-term defined need. Say a business needs to make an extra purchase of inventory, or there is a seasonal buildup of inventory within the business. It's something that is needed only once in a cycle and can be expected to be repaid in less than 1 year. Typically, interest is required to be repaid while the loan is outstanding, while the funds are being borrowed. Sometimes during the term of the note, principal is required to be repaid as well, but it is all required to be repaid at maturity. And again, these are typically very short term in nature. And again, you only borrow it one time. You cannot reborrow it once you repay it. Long-term credit is something that is funded under what's called term loans in a bank. This type of financing is for longer term needs. Term loans support the purchase of machinery, equipment, furniture, computers, or supports permanent working capital while the infrastructure within a business is being built up. The money is borrowed only one time, but is paid back over time, and that's over 12 months. And the term can vary depending on what you're financing. Terms can be from anywhere from 12 months to 5 or 7 years, or sometimes even longer. Typically, a bank will evaluate the total project cost and finance a portion of the amount of the total cost, requiring that equity be put in by the business or by the owner. Mortgages are another form of long-term credit. Typically, real estate mortgages for commercial real estate support the purchase of owner-occupied commercial real estate, not a strip mall, not an investment property. For owner-occupied properties, if there is an existing building being purchased, the business needs to occupy at least 51% of that property to be considered owner-occupied. If new construction is being considered, at least 2/3 of the space needs to be occupied by the business. Any unoccupied space that is available to rent out to an unrelated business cannot be used or relied upon as income to repay the debt. Repayment of real estate mortgages also is made monthly over a period of time. Unlike residential mortgages, however, amortizations or the amount of time that it takes to pay it back are typically less than 20 years. Terms on the notes may be only 5 years with a 20-year amortization as an example. And at the end of the 5 years, the note is repriced and a new interest rate is put on it. No matter what kind of debt that you need, be it short-term or long-term, owners need to expect that the bank is going to require collateral or business assets to secure the loan. They're also going to most likely require personal guarantees of the owner. Don't be surprised if the bank wants you to guarantee the debt as well. If you have any additional questions about getting ready to apply for a loan, please feel free to contact me. Again, it's Jane Rich, Business Advisor with the Northeast Indiana Small Business Development Center, and our office number is 260-481-0500, and my email address is jrich@isbdc.org.